Welcome back to our intermediate financial accounting class. In the last couple of lectures, we've been talking about the accounting cycle, all the different elements of the cycle. We've talked about the accounting equations, we've talked about the elements of the cycle, we've talked about why this is so important to understand for all business leaders, and now, finally, we get to start actually going into the cycle and learning about it. And the first thing we're going to talk about, the first step of the cycle, if you remember, is identifying transactions. And once you have identified the transactions that need to be recorded, then we get to make journal entries. My favorite. I'm so excited. I've been waiting for this. I love making journal entries. So that's where we're at today, is on making journal entries. Anytime a transaction occurs, we use a journal entry to keep track of those transactions. We keep track of the amounts, we keep track of who's affected, the lenders or the equity holders, and we keep track of how the assets are affected. And we make sure every time we do a journal entry that both of our accounting equations stay in balance. Debits are equal to credits, and the change in assets equal the change in liabilities or equity. So we make sure that that happens every single time. Now, to simplify this process, I've come up with a series of steps that I think really keep it simple and straightforward to make a journal entry. For now, we'll walk through the steps one by one, but as you get better and better at these, you'll be able to whip through them very, very quickly without having to stop and really take time to think about each step. Step one is to decide the accounts that are going to be affected. So we're going to look at the specific names of the accounts. Is it cash? Is it accounts payable? Is it accounts receivable? Is it inventory, etc.? And then what kind of account is that? Is it an asset? Is it a liability? Is it an equity account? Once we've done that, that's step one. Then step two is to decide whether the accounts are going up or going down. Once we know whether they're going up or going down, then we can decide, is an increase to an equity account, is that a debit or a credit? Well, that's a credit, and that's step three. Increase to cash, that would be a debit because it's an asset. Step four then is to finally write the accounts down. Notice we haven't done anything with numbers at all yet. All we're looking at is the accounts, the account names, the account classifications, and whether they're increasing or decreasing. Once we've decided that they're increasing or decreasing, we know whether they're debits or credits, we write them down. We list debits first and then credits, and we usually indent the credits a little bit. Some of these transactions can be very long, lots and lots of journal entries. I had a friend of mine talk about doing a 22-line journal entry. Talk about the fun, right? Anyway, but because of the length, you want to make sure that you've set off those credits so that somebody coming by as an auditor or a manager or whatever to check your work can very easily tell the debits from the credits. So we write down the debits, then we indent a little bit, write down the credits, and then finally we put in the numbers. And we make sure that the debits equal the credits in the numbers. Finally, we add in some kind of a description. It doesn't have to be a lot. It doesn't have to provide specific elements most of the time. There are some times that we'll talk about where you do want to include specific elements because they're needed later. But we want to include some kind of a description, again, so that whoever is coming after us to verify or to check or to go through our transactions can see, oh yeah, that's what's going on. So, those are our steps. Let's do some journal entries. Let the fun really begin. So here's our first example. Now we finally get to do a journal entry. I'm so excited. This is my favorite part. So let's take a look at our very first example. And our first example is our owners investing $50,000 in the company. Let's do it together step by step this time. Step number one, decide which accounts are going to be affected. In this case, cash is going to be affected because we're getting more cash. And the owner's investment account is going to get bigger because they're the ones with claim on that cash. So my accounts are cash and owner's investment. Cash is an asset, obviously. Owner's investment is an equity, also pretty obvious with this first simple example. And that's step one. Step number two is to decide increase or decrease. Well, we're getting more cash, so cash goes up. And the owners are the ones that have claim to that cash, so equity is going up. So we've got increases to both. Step number three is to decide, is an increase a debit or a credit? Well, cash is an asset, so the increase will be a debit. Owner's investment is an equity account, so it's going to be a credit balance. So those are the first three steps. Step four is where we finally put pen to paper, or in my case, stylus to tablet, I guess. So let's go ahead and do that. We're going to start with the debit accounts. So there's cash. We're going to then do our credit, which is owner's investment. And you know, this account, more than many others, is going to depend on the kind of company you are. If this is a corporation, then this is going to be a common stock account. If it's a proprietorship, a sole proprietorship, one owner, or a partnership, then it's usually a named account. So in this case, if it were my business, I would actually have Jason's Investment. And that's pretty common to see them named. So that'll depend. It'll tweak a little bit depending on the kind of company you're working with. Step 5, $50,000 and $50,000. And you'll notice that I indented the credits both here and here, so it's very easy to read. Step number 6 is to enter a description. You'll notice that I've erased all of that other stuff so that we have room for our description. We're going to keep this simple. This is basically cash from Jason, who's our owner. And something simple like this, that's all you need. Just enough of a description that whoever's coming after can see what you did. The last thing we want to do with this before we move on to the next journal entry is I want to go through an exercise that I do with my classes, actually in class. And I'm going to try to do this here in this little teeny screen. Hopefully it'll make sense. Okay, remember our basic accounting equation, assets equal liabilities plus equity. And we have to keep that in balance every time, remember. We can see up here that our debits equal our credits. We're good. 50,000 debit, 50,000 credit. So that part's okay. Now we take a look at assets equals liabilities plus equity. In this case, assets went up, $50,000. Okay, then what happened? Equity went up by $50,000, and we stay in balance. And we want to make sure with every journal entry that we see it stay in balance every single time. Let's go ahead and take a look at our next example. And probably the best thing you could do is to go ahead and pause it and do this journal entry on your own. And then in a second, come back and we'll walk through it together. Again, we're going to walk through this step by step. You don't have to do it that way. If you were able to go faster because you're comfortable with this, that's fine. For those of you who maybe are still a little bit hesitant, that's okay. You can keep doing it step by step until you feel really comfortable. So again, step number 1, what accounts are being affected? Well, in this case, we bought office equipment. So we have an equipment account or office equipment account that's going to be changing. That's an asset. And if we purchased it, then we had to pay cash. So we've got cash involved as well. Another asset. So we've got 2 assets, 1 increasing, 1 decreasing. Step number 3, increasing an asset is a debit, decreasing an asset is a credit. So those are my first 3 steps. So now step 4, here I go with my stylus instead of my pen again, and we're going to debit office equipment. And we're going to credit cash. And now, step number 5, we're going to add in the amount, so $10,000. Notice I'm indenting again, so it's easy to read. And finally, step 6, bought office equipment. All right, and there we go. Now again, one more time, well, we're going to do this several times, but again, let's go through this. Okay. Office equipment, assets equals liabilities plus equity. Again, we can see up here that my debits and my credits are equal. Now we want to make sure that assets equals liabilities plus equity. So in this case, we debited office equipment, so assets go up. We credited cash, assets go down, and we stay in balance. Nothing had to happen over here in our liabilities and equity side because the only thing that changed, we exchanged one asset for another and still stayed in balance. Let's go ahead and take a look at the next example. We're not going to go quite as long on this one, but take a minute and do this journal entry to record the payment of salaries. Okay, hopefully you really did it. If not, shame on you. This is fun stuff, so you should be working on it. Let's go ahead and do this journal entry together. I'm just going to summarize it this time. We won't go through all the steps. But if you need the steps, again, keep using them. They're very helpful. Okay, so we paid salaries. So I love that keyword paid. It means cash is involved. And since we paid, my cash is a credit of $5,000. And we're paying salaries. So probably we used a salaries or perhaps a wages. You could use that too. Expense. And my debit, $5,000. This is paid salaries. Okay, so let's go through this again. Here's my accounting equation. Again, we can see that debits equal credits, so we're good there. Now we need to take a look. Okay, assets. Well, let's see, we credited cash, so assets go down. We debited expense. What happens there? Well, if you remember our discussion from the last segment, an expense is a breakout of our equity section. So as expenses go up, equity actually goes down because the owners have less. So assets dropped, equity dropped, and we stay in balance. Cool, isn't it? It all works together, so everything stays in balance, and we're keeping track. Those assets dropped, and the owners have less because we had to pay the salaries to our employees. Don't owe less to the bank, but the owners have less they can claim. All right, with that, we're going to stop here. When we come back, more fun journal entries. Let the fun continue. See you then.